Hello everyone and welcome to my channel. Today I'm going to do revaluation account and then we'll prepare a balance sheet from this. For this purpose I've taken a question. Let's see the question first. I'll suggest everyone to write down the question it will be helpful for you to understand the solution better. So please write down the question in your copy and then we'll move towards the sum. Okay, it's over. See here, in this question, as you can see, there are two partners A and B, and their profit sharing ratio is 3/5 and 2/5. And then this one balance sheet is given. In this balance sheet, a few liabilities are there and few assets are there. And here, under this, below this balance sheet, we have given some instruction. And the first instruction is we are admitting new partner. Yes, you are admitting new partner with capital rupees 6 lakh 6,000 and he's bringing a premium for goodwill rupees 4,800. And then and later we can see some adjustments are there. In point number 2, I am not taking as because it is related to the loan account, and this 2020 loan account is not there in our syllabus due to the pandemic situation. We have deducted deducted some courses, so it is not there this time. This is not there in our syllabus. In point number C, it is given freehold premises undervalued by rupees 5,000. I have told you earlier that we'll prepare revaluation account only on the basis of modern approach of accounting. And what is our modern approach? Increase in asset debit, decrease in asset credit, increase in liability credit, and decrease in liability debit. So here in point number 3, point number 1, it is given C is being 6,000 capital, so it will not consider in, remember it, in revaluation account, capital and premium for goodwill will not consider in revaluation account. That will come under capital account. If someone is new partner is bringing some capital, that will consider in revaluation account, not in revaluation account, in partners capital account. And if it is bringing some premium for goodwill, that also will transfer in new partner, old partners capital account in their sacrificing ratio in their capital account, not in revaluation account. So do not to worry about the point number 1 in revaluation account. In point number 3 is given freehold premises undervalued by rupees 400. It means whatever the value is there of freehold premises that we have undervalued. It means what? We have shown lesser amount in the balance sheet. It is given freehold premises undervalued by rupees 5,000. It means last time we have shown lesser amount of freehold premises. So this time we'll show it. So there is an increase in assets, so debit. So we'll make journal entry freehold premises account debit to revaluation account. Freehold premises debit to revaluation account. So accordingly we'll put by freehold premises in credit side. It's over. Next one, machinery plant overvalued by rupees 5,500. It means what? Machinery and plant we have overvalued. It means we have shown more amount. So this time we need to deduct it. So there is a decrease in asset. Remember it. We have shown overvalued. Overvalued means what? Lastly, if for example, if plant and machinery, if it was plant and machinery, machinery plant, if it was 5,000, we have shown 5,500. It means we have shown more amount. So what we need to do? We need to deduct that amount. So there will be a decrease in asset. So revaluation account debit to machinery and plant 5,000. And next, stock is revalued. So stock is discounted by 10%. Now what is the stock? Stock is rupees 12,500. So there is a discount of 10% in stock. So you need to deduct 10%. So 10% of 12,500 is 1,250 rupees. So again there is a decrease in stock. Next one, investment. Investment are to be brought down at the rupees 3,200. See, it was investment was 4,250 and now it is come down to 3,200. So there is also a decrease in assets. Earlier it was 4,250 rupees, now it was 4,200. So there is a decrease in 3,200. So there is a decrease in assets, obviously it's credit. So investment 1,500. And next is PFDD. PFDD means what? Provision for doubtful debts. I've written in the short form provision for doubtful debts. The provision for doubtful debts is reduced by rupees 1,000. So there is a decrease in liability. Provision for doubtful debts is liability, so there is a decrease in liability. So decrease in liability is debit. So I've written by PFDD. In short form, I've written provision for doubtful debts 1,000. Is over and no more adjustments are there. Then what we need to do? We'll see which side is greater. So you can see this side is greater, so 5,000 plus 1,000, 6,000, that I've written in the both the side, and then three items are there, 500, 1,250 and 1,050. So these three items you need to deduct from 6,000. After that I'm getting 3,200. From 6,000 I deducted these three items and then I got 3,200. So that 3,200 is a profit on revolution. So that we need to transfer in the old partners capital account. So who are the old partners? Here old partners are A and B are the old partners. So I've divided that profit in old partners capital account in their old profit sharing ratio. Now what is the old profit sharing ratio? They are 3:2 because 3/5 and 2/5. So the ratio is 3:2. So on this 3:2 I divided 3,200. So A's capital account getting 1,920 rupees. And B's capital account 1,280 rupees. So that's up to revolution account. And next we'll prepare partners capital account. Now I'm going to show you how to prepare partners capital account. So see here there are three partners are there. So format is particulars and how many partners. In this question there are three partners, so A, B and C. Particulars A, B and C. If there are four partners and then we need to add one more column, this side also and this side also. And then we'll see what is the balance BD. Balance BD means whatever capital is there through which they have started the business. So see there in this balance sheet it is given. If you follow the question, you will see in the balance sheet on liability side it is given capital account A 24,000 and B 9,000. So I have written by balance BD A 24,000 and B 9,000. See here it is given A 24,000 and B 9,000. And see in point numbers, see here one thing we make it clear that all items should be related to the partners, and everything should be related to the partners. So somewhere if they are getting, then if partners are getting any amount, that will put in the credit side. If partners are giving any amount, that will put in debit side. And first we start with the balance BD, that is 24,000, 9,000, and then C as a new partner in point number 1. As you can see in point number 1, C brings 6,000 as capital and 4,500 as 4,800 as premium for goodwill in order to get 1/2/7 a share in profit. It means what? Here C is getting 6,000 as his capital. So if we make journal entry, cash account debit to capital account, C's capital account. Cash account debit to C's capital account. So I write by cash account C 6,000. And then what I have written? By revolution account. In revolution account we got a profit. From this question we have prepared a revolution account, and from revolution account whatever profit we get, that profit I am transferring here. So in this question we got some profit and written by revolution account. Profit, A got profit of 1,920 and we got profit of 1,280 rupees. That we got after preparation of revolution account from this sum. And then as you can see, C is getting 4,800 as premium for goodwill account to get 247 share in profit. So we will make journal entry, premium for goodwill account debit to S capital account and to B's capital account. So accordingly we will write by premium for goodwill account. So that you transfer, normally you transfer it into sacrificing ratio. And sacrificing ratio we can prepare when new ratio is given, because sacrificing ratio formula is old ratio minus new ratio. But in this term new ratio is not given, so old ratio will be their sacrificing ratio. Remember it, if we need to every time we will transfer premium for goodwill in their sacrificing ratio of the old partners. But in this question there only old ratio is given but new ratio is not given. So without new ratio, we cannot find out sacrificing ratio. So I am transferring this 4,800 in A and B on all partners capital account in their old ratio, because old ratio is their sacrificing ratio in this question, as because new ratio is not given. So A will get 2,880 rupees and B will get 1,920 rupees is over, and no other item related to partners are there in this question. Over, and then we will see obviously this side is the greater. So what we need to do? We will add all these items. 6,000, no more items are there, so we'll write accordingly. We'll write 6,000 in the total of C, and then in B we'll add all these three items: 9,000, 1,280 rupees and 1,920 rupees, and then if we'll add all these items, we'll get 12,200 rupees. Accordingly, we'll see in X capital account as 24,000, 1,920 rupees, and C 2,880 rupees. If we add all these items, we'll get 28,800 rupees. And accordingly, we'll see on debit side, we write down to balance CD. CD means credit down. So I'll write down the amount: 28,800, 12,200, and 6,000. So that's over for partners capital account. Thank you.